A trade can look almost effortless. Borrow where money is cheap, invest where returns are higher, and keep the difference. The Japanese yen carry trade is that simple idea until the currency moves against you. Here is the whole chain. Cheap yen funding encourages borrowing. Borrowed money moves into higher returning assets. Calm markets make the trade feel safer. Then one change can force the chain to reverse. A carry trade begins with a funding currency. An investor borrows that currency at a relatively low cost, converts it, and buys an asset expected to earn more than the borrowing expense. For years, the yen often filled that funding role because Japanese interest rates remained low relative to rates elsewhere. The trade was not really a bet against Japan. It was a bet that cheap funding would remain available. Imagine an investor borrows yen, exchanges the yen for another currency, and buys foreign bonds or other risk assets. This is the unhedged version of the trade. If the investment earns enough and the exchange rate stays favorable, the spread becomes the reward. But there are two moving parts, not one. The asset must perform, and the currency conversion must cooperate. A modest yield advantage can disappear quickly if the yen strengthens against the currency holding the investment. That currency risk is the hidden hinge. To repay a yen loan, the investor eventually needs yen again. If buying those yen becomes more expensive, closing the trade can produce a loss even when the asset itself did not collapse. Leverage raises the stakes. Investors may borrow more than their own capital because the expected spread looks small but dependable. Leverage can magnify steady gains, but it also turns an ordinary currency move into a forced decision. When many investors use the same funding logic, unrelated markets can become connected. Stocks, bonds, credit, and emerging market assets may all contain money financed through the same cheap currency, even when their individual stories differ. What can break the pattern? Japanese rates may rise, rates elsewhere may fall, market volatility may jump. Risk assets may weaken, or the yen may strengthen because investors suddenly want safety or expect a policy change. Then the unwind runs backward. Investors sell assets, convert the proceeds into yen, and repay their loans. That buying can strengthen the yen further, pressure more carry trades, and create another round of selling. This is why a carry unwind can travel beyond the currency market. The funding source sits underneath many positions. When that source becomes expensive or unstable, investors reduce risk wherever they can, not only where the original problem began. To read the trade, watch the chain rather than one headline. The gap between Japanese and foreign rates, the direction of the yen, market volatility, and signs that leveraged investors are reducing exposure together. The lesson is not that the carry trade is always reckless. It is that a calm return can hide a fast-moving repayment risk. Ask where the funding came from, what keeps it cheap, and what happens when everyone needs the funding currency back.